What if I told you a tiny number, less than 2%, could cost you hundreds of thousands of dollars over your lifetime, a silent wealth killer? Most people don't even know it's sitting quietly inside their own portfolio. Today we're breaking down the massive difference between index funds and mutual funds. This isn't just about investing, it's about how you're potentially being robbed. Robbed of your early retirement, one small fee at a time, silently. For decades, Wall Street sold us an idea: you need a professional. Someone in a suit, with a fancy degree, picking winning stocks for you. This is the world of active management, otherwise known as mutual funds. They tell you they can beat the market, protect you during crashes. But there's a price for this so-called expertise, called an expense ratio. On the other side, we have the boring alternative index funds. No fancy managers, no one guessing the next Apple or Tesla stock. Just a simple algorithm buying every stock in an index, like the S&P. It doesn't try to beat the market, it simply is the market. Let's talk about that 1 or 2% fee everyone dismisses casually. Most people think, it's just 1%, what's the big deal here? But you're not paying 1% of your profits, remember that clearly. You're paying 1% of your entire balance, every single year, always. Whether the fund makes money or loses money, that fee still applies. If the market grows 7% and your fund charges 1.5%, they aren't taking a small slice, they're taking 20% of gains. Every single year, that fee quietly eats into your annual returns. Over 30 years, lost compound interest can swallow 30 to 40%. 40% of your entire final nest egg, gone to fees alone. You do 100% of the work, take all the risk. But the fund manager still takes 40% of your total reward. Why do people still pay these fees despite everything we just covered? Because they believe the manager will beat the market somehow, reliably, consistently. But the data tells a completely different story than the sales pitch. S&P Dow Jones Indices runs a study on this every single year. Time and time again, the results are honestly pretty shocking to see. Over 15 years, more than 90% of actively managed funds failed. Failed to even beat the simple S&P 500 index over that period. So you're paying a premium price for a product likely to underperform. In any other industry, this would honestly be considered a scandal. If a premium car was slower than the budget model 90%, you'd want your money back immediately, no questions asked, full refund. In finance, they just quietly call this whole thing management instead. There's another hidden layer to all of this: taxes, quietly working against you. Active mutual funds trade stocks constantly, buying and selling all the time. Every time they sell a winning stock, it triggers a capital gains tax. And guess who actually pays that tax bill? You do, every time. Even if you never sold a single share of the fund yourself. Index funds are passive, they rarely buy or sell anything at all. Only when the index itself changes, which honestly doesn't happen very often. This makes index funds incredibly tax efficient compared to actively managed alternatives. Your money stays invested, compounding year after year, without unnecessary tax drag. Wall Street makes investing look complicated because complexity is genuinely profitable for them. If it's complicated, you need a guide to help you through it. And if you need a guide, they get to charge you a fee. Index funds prove the simplest path is often the most profitable one. As John Bogle, the father of index funds, famously put it once: don't search for the needle in the haystack, just buy the haystack. Let's put real numbers to this with two friends, Alex and Ben. Both invest $1,000 a month for 35 years straight. Alex chooses an index fund with a tiny 0.05% fee. Ben chooses a mutual fund instead, with a 1.25% fee. Assuming a 7% market return, Alex ends up ahead significantly. Alex ends up with over $1.7 million after 35 years. Ben ends up with only about $1.3 million in comparison. That 1.2% difference cost Ben $400,000 total. That's the cost of an entire house, gone, just from fees alone. That's the cost of retiring 5 full years earlier than planned. Ben worked just as hard as Alex did, every single year. But his money worked for the bank, while Alex's worked for him. The truth is, you can't control what the stock market does tomorrow. But you can control exactly what you pay in fees today. Your homework today is simple: log into your brokerage account right now. Look for the expense ratio column sitting quietly in your account details. If it's over 1%, ask yourself something important right now. Is this manager really worth $400,000 of my future? Stop paying for underperformance, minimize your fees starting today, right now. Maximize your time, and let the market build your wealth quietly. If this helped you see your finances differently, hit that like button. And subscribe for more deep dives into mastering your money going forward.